In the 1920s, America was a party, and the invitation was open to everyone. It was the Jazz Age, the Roaring Twenties, a decade-long explosion of wealth, optimism, and cultural revolution. For the first time, ordinary people could buy cars, listen to the radio, and, for the first time in history, get rich on Wall Street. It felt like the rules of gravity and economics had been suspended. A new era of permanent prosperity had arrived. But it was all a lie. Underneath the glamour and the jazz, a dangerous financial poison was spreading through the system. A poison of greed and debt that would lead to the single greatest economic catastrophe in modern history. This is the story of the Great Crash of 1929, the week when the American dream died and the Great Depression began. To understand the crash, you have to understand the madness that came before it. The stock market of the Roaring Twenties was a phenomenon. Once the exclusive playground of the ultra-rich, Wall Street was now being sold to the masses as a one-way ticket to wealth. Brokerage firms opened offices in small towns across the country, and the number of Americans who owned stock tripled during the decade. For many, it felt like a patriotic duty to invest in America's booming industries. But this wasn't really investing. It was gambling, and the casino was offering everyone free money to play with. The mechanism for this madness was called buying on margin. It was a dangerously simple idea. You could buy a stock by paying only a small fraction of its price, as little as 10%, and borrow the rest from your stockbroker. It was like buying a $100,000 house with only a $10,000 down payment. As long as the price of the house went up, you were a genius, making huge profits on money that wasn't even yours. But if the price dropped even a little, you didn't just lose your down payment. You still owed the bank for the rest of the loan. In the 1920s, millions of ordinary Americans were taking out these massive loans to bet on the stock market, and the entire system became a mountain of debt resting on a pinhead of real money. With so much borrowed money flooding the market, a speculative bubble of historic proportions began to inflate. People stopped caring about a company's actual profits or its business model. The only thing that mattered was that its stock price was going up. Stocks for companies like RCA, a leader in the new radio technology, soared by over 500% between 1927 and 1929, despite the fact that the company had never paid a dividend. It was pure, irrational exuberance. People were buying stocks not for their value, but with the hope of selling them to a greater fool for a higher price tomorrow. To make matters worse, Wall Street invented new ways to add fuel to the fire. Investment trusts became wildly popular. These were essentially unregulated mutual funds, companies that did nothing but buy the stocks of other companies, often using borrowed money to do so. This created a house of cards, where layers of debt were stacked on top of other layers of debt. By 1929, the market was no longer connected to economic reality. It was a fantasy, a collective delusion that the party would never end. A few seasoned financiers, like banker Paul Warburg, tried to sound the alarm, warning that the rampant speculation would lead to a disastrous collapse. But no one wanted to hear it. The music was too loud, and everyone was dancing. The music finally stopped in the fall of 1929. On Thursday, October 24th, the fantasy began to crumble. The day started with a wave of selling, and as the ticker tapes fell further and further behind, a quiet unease turned into outright panic. The market was plunging, and no one knew where the bottom was. In a dramatic attempt to stop the bleeding, a consortium of Wall Street's most powerful bankers, led by the acting head of the New York Stock Exchange, Richard Whitney, strode onto the trading floor. They conspicuously began placing huge buy orders for blue-chip stocks, a move designed to project confidence and calm the market. For a moment, it seemed to work. The market rallied, and the nation breathed a sigh of relief. The newspapers called the bankers heroes, but they hadn't fixed the problem. They had only built a temporary dam against the tidal wave of selling. The dam broke just a few days later. On Tuesday, October 29, 1929, Black Tuesday, the tidal wave hit. The opening bell was met with a deafening roar of "Sell, sell." The bankers' emergency fund was instantly overwhelmed. Panic was absolute. A then-record 16.4 million shares were traded as investors desperately tried to unload their stocks at any price. By the end of the day, the market had lost another 12%, and an estimated $14 billion in wealth had vanished into thin air. That was more than the entire U.S. federal budget for that year. The real horror of the crash was magnified by the magic of margin. As stock prices plummeted, brokers made margin calls, demanding that their clients repay the money they had borrowed. But the client's money was gone, wiped out in the crash. To cover the loan, they were forced to sell their remaining stocks, which pushed prices down even further, triggering more margin calls and more forced selling. It was a vicious, self-perpetuating death spiral. In a matter of weeks, the market lost nearly half its value, and the fortunes of millions of Americans, from Wall Street tycoons to teachers and factory workers, were annihilated. The Wall Street crash of 1929 was not the sole cause of the Great Depression, but it was the spark that lit the fuse of a global economic powder keg. The consequences rippled out from Wall Street and devastated the real economy in a few key ways. First, it destroyed the nation's banks. In the 1920s, many banks had irresponsibly invested their depositors' money in the stock market. When the market crashed, the banks were instantly insolvent. Worse, many had made loans to individuals who were buying on margin. When those loans went bad, the banks failed. This set off a wave of bank runs across the country, as terrified citizens rushed to withdraw their cash. Over 9,000 banks failed in the 1930s, taking with them the life savings of millions of ordinary people who had done nothing wrong. Second, the crash caused a collapse in consumer demand. People who lost their savings in the crash, and even those who didn't, were terrified of the future. They stopped buying everything but the bare essentials. When people stop buying, businesses can't sell their products. When businesses can't sell their products, they fire their workers. By 1933, unemployment in the United States had reached a staggering 25%. Finally, in a catastrophic display of bad timing, the U.S. government made the problem infinitely worse. In 1930, Congress passed the Hawley-Smoot Tariff Act, which raised taxes on thousands of imported goods. The idea was to protect American industries, but it backfired spectacularly. Other countries retaliated by taxing American goods, and global trade ground to a halt, plunging the entire world deeper into the Great Depression. So, could a crash of this magnitude happen again? In the aftermath of the Great Depression, the government put safeguards in place to prevent a repeat performance. The Securities and Exchange Commission, SEC, was created to regulate the stock market, and the Federal Deposit Insurance Corporation, FDIC, was established to insure bank deposits, ensuring that a bank failure would never again wipe out people's savings. But human nature hasn't changed. Greed and fear are still the dominant emotions that drive markets. We've seen modern bubbles, from the dot-com boom of the late 90s to the meme stock craze of 2021, driven by the same kind of irrational exuberance and speculative frenzy that gripped the nation in the 1920s. We have new, complex financial instruments that concentrate risk in ways that few understand, and global debt is at levels that make the 1920s look tame. The safeguards are stronger, but the system is bigger and more complex than ever. The story of the 1929 crash is a timeless lesson in the dangers of debt, the madness of crowds, and the devastating consequences of greed. It's a reminder that when the promise of easy money seems too good to be true, it always is. And when the party finally ends, it's ordinary people who are left to pay the bill. If you learned something, hit subscribe. Have a great day.